All right, welcome everybody to the live trading for the Fed meeting. We'll get started in a couple minutes. So the first thing that's going to come out is the interest rate hike. Second thing that's going to come out is the summary of economic projections. So we're going to go over to the Fed website and watch for that data release first, and then in about 30 minutes, Powell is going to come on and give his press conference at 2:30 p.m. So first things first, let's go to the Fed meeting. Let's see, Fed meeting calendar. And we're going to have to refresh this page and go to, let's see, December, I guess, right here. And I will send the link whenever it's available. So right now it's 1:59. Got about 40 seconds until it releases. Right now, SPY is trading at 405, so get ready to either make a lot of money or lose a lot of money. We'll see which way this goes. Initial reaction is going to be based on 50 basis point or 75 basis point, which it's likely to come in at 50 basis point unless the Fed decides to pull a fast one on us and do a 75, which goes against market expectations, which would make us fall about 7%. If they do the 50 basis point, you're likely to see a little bit of a rally, but then the summary of economic projections is going to be what gives us all the info we need for the future. So it looks like 2 o'clock bell just hit. Initial reaction is down some more, down some more. 402.56. Let's pull up the data if we can. Hopefully they don't overload the pages. I'm surprised that their servers can handle, I'm sure, a crap ton of traffic that's coming. But that's the link to the press release. So let's see if we can find the rate hike. In support of these goals, the Fed committee decided to raise to 4.25 to 4.5. So if we go over to the FOMC watch tool, I think that was a 50 basis point. But let me double check. And our initial reaction is down to 402. You have Fed Chair Powell coming out and speaking in about 30 minutes, so we'll see what the reaction is to him. But initial reaction upon the FOMC release is down. I guess this is taking forever. Fed raises key overnight interest rate by 50 basis points. So we got the 50 basis point, but we're still headed down. So what really matters, and what I've been talking about for the last couple of days, is the projection materials, or what the Fed estimates the rates to go to for the highest interest rate in 2023. And then the long term. So this is the new summary of economic projections. I'll pull up the old one after we go through this. So they raised the top rate to 3.3. So we didn't get a change in the bottom rate. So that means the doves are still hanging on to their 2.3 longer run. So 3 to 5 years interest rate. Okay. And then the top rate looks like we just broke 402. But the top rate that they're expecting, wow, went up to 5.1 to 5.4%. So let's check the old one and compare. Okay, so let's go to FOMC meeting calendar again. And I want to say that was like 4.5 to 5%, but let me just double check. That's why you're getting the sell-off. It doesn't matter. The 50 or 75 basis point rate hike does not matter because we already knew that. But we didn't know that summary of economic projections. So let's go to September. Projection materials from September and compare. So if we look at the old one, they were estimating 4.4 to 4.9% as a top rate for 2023. So now they went to 5.1 to 5.4%. So that is a 60 basis point jump, which is pretty significant. That means they're working their way up. You know, if they continue this financial tightening, they're working their way up all the way up to 6%, which is where they really need it to go in order to get real rates, or the difference between inflation and interest rates, below zero. You want to get the real rates to where you're disincentivizing borrowing, right? That's how you get a financial tightness. Audio quality isn't the best. I think it's something to do with my new OBS setup. I'm not really sure how to fix that, but hopefully it's good enough to get through this meeting. Initial reaction, we're making some money. Good. These 403, 402 put debit spreads are going for 60 a piece now. Good to see that. Could be worth taking profits on some of these. I've made $300 on these so far, up about 40% for these contracts so far. Let's see, the put credit spreads that I had open this morning, I held on to just 5 of them, just to de-risk because I'm heavily levered to the downside. So for this one, let's see, 399, 398 put credit spread. I do think that there's a chance that Fed Chair Powell comes out and maybe kind of reverses what's going on right now. Usually the first reaction upon the release is the opposite to the reaction to Fed Chair Powell. So there's some chance that we rebound if he comes off dovish. So you have dovish, you have hawkish. So if Fed Chair Powell gives any sort of hint towards lowering interest rates in the near term, that's what the markets want to see. But right now they're focused more so on the length and the height of interest rate hikes. So they reduced the pace, right? And this is something that he talked about in the last meeting. They're not only focused on pace, they're focused on the height, the highest interest rate, which went to 5.1 to 5.4%. And then finally the longer run, so how long they're going to keep these high interest rates. And then the longer run, the next 3 to 5 years, they're planning to keep rates between 2.3 and 3%. And I've covered this 100 times on the channel, but the last time that we had interest rates above 2.3% for more than 3 to 5 years was 2008 and 1994 to 2000. So pretty bad look for long-term rates. I would imagine that bonds are going to come down some. I opened a TLT call credit spread, which not really changing the price on TLT, interesting enough. I would think that interest rates would be going up because this was a surprise to the upside with their 5.1 to 5.4 target, if I'm thinking correctly. If we look at the FOMC watch tool, we can actually look at the longer term expectations set by the banks. So FOMC watch tool, mic is doubling. Can you still hear me doubling? Or is it fixed now? Let me turn this off. Okay, is it still doubling now, or are we good? I turned the mic off on the OBS, so if it's good now, press 1 on the chat. If it's not doubling anymore. Okay, thank you, Joe. Sweet. Sorry about that. But, yeah, these 399, 398 put credit spreads were down about 25%. Still want to hold them just in case we have a reversal and Fed Chair Powell speaking. I do want to reduce my risk on the downside, maybe close out of these 403, 402 put debit spreads. But I do have a really big trade that I'm taking on, which is this 396 to 397 call credit spread. And this one I'm down 500 on, but I do think that there's going to be more volatility ahead. So there's a chance that that one's going to be doing pretty well later. So let me close out of the put debit spread, the 402, 403. The spreads are going absolutely berserk right now. I'll try to close them. I'll type in 60. Okay, that should be an easy close now that it just dropped below 300. So I had 15 of them. I originally bought them for 43 each. So I'm going to close them at 60, and that'll go to the trade alerts Once that order is filled, we actually got $945 of credit, so a little bit better than the 60 that we asked for. But let me pull up the Discord and post that trade alert. Nice little $300 or so profit, which always love to see it. Let's see. So that is a closing options alert, premium 101, premium. Just took profits on the 402, 403 SPY put debit spread. That one expires today, 12/14 at 945 over 15. We got paid 63 each. 63 each. Let me actually move this over so y'all can see. SPY 402, 403, 50% profit for right now. That's good. Very, very nice. Looks like we don't have that. 402. I'll type in put debit. Just took profits on it. Okay, where's the one that we freaking opened? Where is the open alert? Ugh. How annoying. There we are. That's what we like. Opened 20, or actually 15 at 45. So 63 minus 45. 18 times 15 made nice little $270 profit. Thank you, Jerome Powell, for the money. Jerome Powell is my personal money printer. Let's see. What else we got here? Got some more money on the line. That put debit spread. The 391 is actually breaking even that I opened previously. This is the one that I think could pay out very big. I ended up picking these up for just 13 cents each. I think I want to close them at like 20 cents, which isn't going to be a lot because I only opened 20 of them. So that's 6 times 20, $120 profit. It's a nice little bonus, I guess, for the day, but that one could also pay off very big. So I think I'm going to close half of that position rather than closing the whole thing once these options reach about 20 cents of value. So this is a 391, 390 put debit spread that I'm looking to close. And I originally opened these at 14 cents each. So we'll see what the payoff is on this. I already closed most of my put credit spreads, so we can only lose about another 200 or so on this. This is going to be our hedge just in case, Fed ends up coming out, or Fed Powell comes out dovish or bullish, whatever you want to call it. But yeah, that summary of economic projections pretty brutal on the top end at 5.1 to 5.4%. That was a major increase. And I wanted to look at the Fed Watch tool to see what the CME group was predicting rates to go for the long term. So if we look at December of 2023, they were expecting the rates to top out at 425 to 450 by the end of next year. So they were 75 basis points off, which is a big margin whenever you're talking about just 500 basis points. So now this is going to have to adjust to the upside. That means that all rates across the board are likely to go up for Treasury yields. So it's going to be very interesting, to say the least. Okay, so this one got updated to 475 to 500, and you can actually look at previous data. So after the Fed meeting today, this jumped from 31% estimated at 475 to 500 to 43%. So that's a 10% increase in the likelihood of a 4.75 to 5% Fed funds rate. Opening 2-month puts, that might not be a bad idea. I wonder how you VIXies react into this mess. Because this is a volatile event. This is going to take some implied volatility out of the market, but at the same time, if there's enough fear around the interest rates going as high as they're supposed to go based on what the Fed is saying. The volatility, the implied volatility could go much higher. So, damn, we got 129 views already. We got 46 viewers and 5 likes. Need more likes on the video, but got a lot of views so far. Nice to see y'all here, and nice to have y'all hopefully making some profit with me. So we're trading at 401 for SPY. The 10-year Treasury yield looks like that jumped up. So the 10-year Treasury yield, why aren't we moving much? I mean, they're waiting on Fed Chair Powell now. So we got a decent move to the downside already, hence why I closed the 402, 403 put debit spreads. But now it's all waiting for Powell, who's about to come out and speak in about 16 minutes. So I'll give you one for $5 US. I have to pay you for likes? Oh, man. You're brutal out here, Otic. Well, if you've been following the trade alerts, then you just made how much money on that? $300, right? Let's see. If you follow the trade alerts, you made $270 of profit. So if we do the math here, 270 divided by 5, you should give me 54 likes, right? Is that how this works? Yeah, you're right. I did lose a crap ton of money. And the early half of this month was brutal. But we're making it back. Let's see. We make money, we lose money. It goes back and forth. Yeah, I started the month at like 38,000, went all the way down to 32,000. It was very brutal, but making our way back up, 35,000 right now. So just a few $1,000s in order to break even for the month. All right. So let's see what else we got going on. The put debit spreads. So the 390, 391s are losing their value. Still going to wait on the Fed. Going to wait for Papa Powell coming in at 2:30 in about 14 minutes at this point. So we'll see how this goes. Yeah, you got this. It always ends up positive in the end. Always going to have bad weeks. Especially that there was 1 week, I think I lost like 6,000 in like 1 week, if I remember right. Very brutal week. Yeah, it went from 37 all the way down to 32, so like 5,000 in a week. Super brutal week. But usually these are the type of events that I thrive on, so gotta love Fed meetings. Again, Papa Powell is my personal money printer. All right. Well, should we make any trades ahead of the Fed meeting? Ahead of Powell speaking? I feel like I've already got a lot of trades on, but I kind of want to take another. Now, obviously, we don't know how Powell is going to, come off. So I wouldn't put a lot of money on it. So this is a binary event, right? So it's either going to be good or it's going to be bad. There's kind of no in between. If I had to guess, I would think that he's going to let up on the hawkish talk a little bit, just given like the uncertainty that we're kind of creating with this high interest rate hike. So I do think that there's a chance that we might not just brutally sell off, but I wouldn't put a lot of money down on it. Okay? Let's say that we stay... Let's look at the hourly chart for reference. Dude, what was this day? That is a crazy... Those are some crazy-ass candles. So let's use this candle for reference. 394.22 it opened, so this is going to be a candle of significance. Let's do the average, 394.22, closed at 399.72. Divide that by 2, and you get 396.97. So let's just say that we stay above 396. So this will be a put credit spread, and I'm assuming that will be 396 or above by the end of today. You're probably going to get a handsome credit because of the high implied volatility. I'm sure those options are going for a lot of money, so the higher the implied volatility, the more credit that you're generally going to get for an iron condor, depending on how high it is. So 396 is the price level I'm assuming we're going to stay above. It's going to be a put credit spread, and I don't want to spend a lot of money on it because that's just another 1% away. This will be a hedge against the bullish position or the bearish positions that I already have open. So y'all already seen all the different bearish positions. I have the 391, 390 put debit spreads. I have, I feel like I'm just like naming off different, what is it called? Pokemon cards. I got 390, 391 put debit spreads. I got the call credit spreads, assuming that we're going to be below 396. And then let's see, this was the small one, but a big payoff, iron butterfly, assuming that we're going to fall by like 7%. That one probably not going to play out anymore. That was based on the Fed doing a 75 basis point rate hike. So this one's probably not going to work out. So we're going to lose 400 on that. So that's all right, as long as we make it back with the other trades. So again, I'm going to do a put credit spread, assuming that we're going to stay above 396. It's not paying very well. So that's my kind of contention against it. It's paying decent, I'll say. Actually, the price just went up, so let's see if we can get a decent credit out of it. Again, I only want to risk like 300, so it's only going to give me like $100 of credit total, so it's not a lot, but if we're wrong on the bearish trades, it'll save our ass a little bit at least. There we go. All right, so just open that put credit spread, assuming we're going to stay above 396. And that'll be our hedge for today. So let me type in, let me send that over to the premium chat room. Discord, please. Will you turn on a speech? Yes, I will, Roddick. And I'll cut myself off, too. I won't speak during his speech, because I know. I've watched other streams around the Fed meeting and where somebody else is talking over the Fed member, and it's just really annoying. I hate when people do that. Like, anyway, just opened a new 396. Let's see, 395. SPY. This one expires today. This is a day trade. Okay. All right. Day trade. All right. Sweet. Just sent that through. Powell speaking in 8 minutes now. Expecting some dovish talk on worries of recession for next year, which might cause the markets to reverse after selling off on the summary of economic projections. Buy some call since it's down. I mean, you can. I just wouldn't really be too bullish on it. Let's see. I'm starting to think that more dropping on a speech. Yeah, so he could accelerate the sell-off too. It's funny. I mean, the stock market, SPY is either going to go up, it's going to go down, right? It's going to go one direction or another. I think there's a very low likelihood of it trading flat, which could be another hedge too. Like you could be a, what would it be? Like a anti-consensus. I forget what the proper term for it. Like what if the market just ends up trading flat on this? That would be the most chaotic outcome. I'm more levered to the bearish side. So if you look at the trades that I have open, put debit spreads, assuming we're going to go all the way down to 390. I do have some put credit spreads that I had opened. Then I have 396, 397 call credit spread. So I'm assuming that we're going to be below 396 with that one. And that's all the trades that I have. So I'm just trading SPY on this event. I think that there's some earnings coming out that we might want to get into before the Fed meeting. So I was looking at Adobe earlier for this week. Their earnings is actually tomorrow. Kind of wish I had made this trade earlier because now it's already dropped a crap ton. And I'm assuming that Adobe is going to have a pretty rough earnings report. Obviously, like there's no telling if it's going to be good or bad before the release. But I think Adobe is going to have a pretty bad earnings, and they already sold off a lot with the rest of the market, but they are only down to 1% today. Obviously, it would have been better to short it yesterday when it was all the way at 355. But I was actually looking at doing a put debit spread for Adobe, and I think it's going to go back down to where it started the week, which I think was $330. So my assumption, it's going to come down about 10 points or 9 points from where it's at right now. I think that the Fed meeting could accelerate that. So let's see. I don't want to put a lot of money on this. Again, it's a binary event, just like the Fed meeting today. So probably only willing to risk like $400 for this trade, but put debit spread assuming it's going to be below 330 is my guess for Adobe after the earnings report. I'm going to set the expiration date for this Friday. Usually whenever I do a Thursday earnings, which is Adobe's going to be a Thursday earnings, I extend the expiration date for the next week. So I would choose the 23rd, but I think with the Fed meeting, it's going to accelerate the sell-off. So I think it's worth shortening the expiration date for that. And then hopefully we can sell... hopefully we can sell the put option before their earnings tomorrow after hours. It's going for a decent credit. It's about 2 times leverage that I'm getting out of it. Kind of wish that I could actually read the bid-ask spread, but it's too small of a screen. 245, 180. Fed is about to speak in about 4 minutes, so I'll try to make this trade quick. And again, I'm only willing to risk like $400 on this, so. I actually got it for a better price than I anticipated. Nice. All right. Post that over in the Discord, and then we'll get this Fed meeting started in about 3 minutes. All right. Oh, the ex-dividend date for SPY is coming up. I didn't even think about that. All right, so let's see. Adobe put debit spread. Just opened a new Adobe put debit spread. That one expires this week, 12/16. Let's see, 424 over 2. Okay. Got my strike prices. Right. Okay. New options alerts. Premium 101. Premium. Let me take a screenshot of the strike prices for everybody to see. and then Fed meeting will start in 2 minutes. And I will cut my mic off so y'all don't have to listen to me. You can just listen to Papa Powell and what he's got to say. Adobe earnings tomorrow after hours. Analysis in premium weekly watch list. That's the wrong dates. Alright, so the Fed meeting is about to start in 1 minute. I'll pull this up. Beautiful Papa Powell with his smoker teeth. And I'm going to cut my mic off and let him speak. So let's see. Let's make sure that my audio output is working. Yep, looks like the audio output is on. So it should start in just a couple minutes. Okay. Get ready, everybody. About to make a lot of money or lose it. Alright. Should be gone right now. Let me refresh this. Nope, nada. If anybody else has a stream to it, that's currently live. Fed Powell live. Okay. There's 7.
Going the extra mile is more rewarding with American Express Business Platinum.
I grew up in the Caribbean. After that, I have been making the effort to affect change. Ithaca is a wonderful place for family. It's a safe space that you're able to engage with like-minded people and find your path.
There we go. All right, I'm going to cut myself off. Why is he late, though? I feel like that's bearish.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the speed, the pace with which we were moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy, and that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be, how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe. yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's not going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome, and you do hear many labor economists believe that it is. So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
No, we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally and improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, you know, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report. You don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
There's a, excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies are getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficiently restrictive. We laid out today what our best estimates are to get there. It boils down to how long do we think this process is going to take? And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of employment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we can get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored, and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these potential exacerbations in inequality? Are you monitoring that?
We do, yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. You're at or above maximum employment, in 50-year low in unemployment. Vacancies are very high. Nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is, and that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No. I mean, what we do is we make our forecasts and we publish them quarterly. And, if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not. We all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course. That's something that we know and we'd see. But as I mentioned, we wouldn't. I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are, so that it would mechanically happen like that. It'll be a test of for cutting rates. I think in the event it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
You're welcome, Mr. Powell. I heard my name on there, but I didn't get to ask a question. Press 1 in the chat if y'all can hear me, just making sure that my audio is coming through. So I wrote down a few key points that Powell came out about, but nobody probably cares about my key points. What people are going to be reading is the headline. So let's read through, I guess, just a couple of the key points that he made. No one knows if we're going to have a recession. So basically he's telling us that we don't know if we're going to get a soft landing or not. If the Fed doesn't pull off the soft landing, this is something that I tweeted about a couple of days ago, I think. One's in the chat. Thank y'all for that. Let's see. Going over to the Twitter page. If we don't get a soft landing, basically people are going to lose trust in the U.S. monetary system. This is a theory that I came up with yesterday. If the Fed doesn't give the economy the soft landing, if they say they will, i.e., if we do get a recession, trust will be lost in the U.S. monetary system, especially after the transitory miss. So what are the odds that they miss again? Now, the thing about inflation is whenever it's super high like it is right now, a recession is the solution in order to get rid of it. You need lower demand. You need the economy to slow down. You need to pump the brakes in order for inflation to come down. I mean, it's just a destruction of demand that has to happen in order for prices to come down, because prices are only a product of supply and demand. Yeah, so no pivot in 2023. Another key point that he had made, which is the markets have been on this hopium of, yeah, we're going to get the Fed pivot in 2023. Like I've heard some analysts saying, oh, yeah, we're going to get it in Q1 or Q2, and that's just hopeful thinking. And if you're basing your trades or your investments on hope, it's not a winning strategy. Don't fight the Fed is what I'll say. People loved that saying whenever the stock market was doing really well, but obviously now that the stock market isn't doing so hot, people don't like that saying so much anymore. But yeah, don't fight the Fed. So I opened a put credit spread assuming SPY is going to stay above 399. So far, we've got a slightly bullish reaction, so we basically reversed all of what we lost whenever the summary of economic projections came out. My estimate is above 399. Right now, we're trading at 401, so we're cutting it pretty close, and Robinhood's going to close us out anyway in about 10 minutes. So let's see what we can get for these spreads. Right now, the bid is 18, and we're closing this for a debit, so we have to go with the ask price, and that is going at, let's see, 18 cents. I really wish Robinhood had a freaking actually usable, like, interactive, what is it, not interactive, but like whenever you shorten this or narrow the screen, it should be visible. But anyway, I should know that. I literally used to do that for a living. But yeah, the ask price is 19 cents. I originally sold these for 30, so making a little bit of profit on it. Right now, SPY is fighting for that 401.44 mark. Still got 10 minutes. I think we're probably going to sell off now that Fed Chair Powell isn't pumping the market anymore. So let's try to get out while we can. The ask is all the way at 22. I think I can get out at 20 if I try quick enough. 5 of these is what I open. So let me see. Hopefully, fingers crossed, Robinhood actually fills me for this order. There we go. Sweet Jesus. All right. So I'm out of that trade. I'll post that to the premium Discord on the other screen. But made a little profit on that, like $70 or something like that. So closing options alerts, premium 101. Whoops, that is not an @ symbol. Just, yes, responsive UI. That's what I was looking for. Yeah, CSS. Just took profits on the 399, 398 SPY. Put credit spread at 20 each. Originally, I had to open those for 30. Right? I think I did. Oh, no, I didn't get 30. What the hell, man? What did I get? I'm confused. I'm gonna have to go through this. I make too many damn trades. Where is it at? Ugh. I can't even find it. I know that I posted it. Just don't know where. There we are. That was 396, 395. Did I type the wrong strike prices? No. I didn't. What the hell, man? Okay, well. Anyway. Alright, so I think we're probably going to head down for the rest of the day. Now that we don't have Powell to pump the markets up, given that the summary of economic projections was pretty freaking rough. So I'd set my expiration date for tomorrow probably. And, I don't know, I'd say it's reasonable to assume we'd go below 400. We're trading at 401 already, so probably not going to get much leverage out of that, but assuming maybe under like 398 could be a solid idea. Too many. Yeah, I do. I trade way too much. Spend too much time at the casinos, but reduce our losses for the day. I was down 500 this morning. Now I'm only down 300. Kind of wish I had taken profits, but that's okay. We're making progress, getting back to that $38,000 mark that we started the month at. What else we got here? We got that 395, 396. These are basically worthless at this point. We could probably let these expire, but I'm going to close it just for safety purposes. I don't want to have to deal with getting assigned early well, not assigned early, but getting assigned if it goes between the strike prices. So I'll close them at 5 cents. I originally opened them at 25, so another nice little small profit. If it closes at that price, let's see. There we go. Yep. All right. Roulette, yeah, trading roulette. Which one will die? Closing options alert. Whoops. Premium. 1 premium. Just took profits on the 396, 395. Put credit spread. That one expires today. 1214 at 5 cents. Whoops, that is not a zero. 5 cents each. And that one we do have the history for. That one is right here that we opened for 25 each. Opened at 25 each, and we opened 4 of them, so 4 times 20. Nice little $80 profit. 80 profit. Whoops. So, nice little gains that we got out of that. Helps ease the pain of the losses that we took. So I did end up taking some losses while Jerome Powell was speaking. So I had a call credit spread assuming SPY would go back down to 396. Obviously that hasn't happened. Maybe if I extended the expiration date for tomorrow, it probably would have worked out. But I was so focused on today's expiration. So maybe next time, whenever the Fed's speaking, we give a couple options with another 1 or 2 days until expiration. That might be a better idea. So right now, SPY is trading at 399. Let's say it goes back down to 396. Let's play again. What is the definition of insanity? Isn't it, if you keep trying something and keep failing, then you're insane? I don't know. Anyway, so I'm going to try 396 put debit spread, assuming we're going to go below that. I'm going to give it till Friday. So I'm going to give it an extra day. Doing the same thing over and over again. Yeah, exactly. That's what I'm looking for. Y'all are so knowledgeable. Got to try 45 days out. Too much of a degenerate for 45 days. And there's too much volatility for 45 days for me. Like, I'm terrible at judging, like, 3-week time frames, let alone 45 days. That's 6 weeks. Ugh. Yeah, doing the same thing, expecting different results. We'll see. We'll see if my insanity pays off or not. So I'm going to set the expiration date for the 16th. Again, this is going to be a put debit spread, and that's assuming that I'll say 397. Let's be conservative here. And that's only like $2 away, so chances of that sell-off happening is pretty good. You are paying a pretty fat credit or a pretty fat debit for it. Let's see. Well, listen, this time will be different. Yes, this time will be different. We're going to make some money, hopefully. And if we don't, then we lose money. All right. I don't know. Like, these are kind of expensive contracts. I don't know if I want to pay that much for them. Ugh. Gross. I hate overpaying for contracts. But we might just have to. Screw you, SPY. It's already going down and making these contracts even more expensive. Come on now. Just give me some cheap contracts, please. Okay, maybe if I shorten that expiration date, that'll give us a better price. So assuming, again, we're going to be below 397, do I sell options? I mostly do spread options. That is my go-to, is spreads. Just because you have a defined risk, defined reward. I've always kind of had a keen towards that. You get to define your risk-reward ratio, which is what I really like out of it. But these put debit spreads expiring tomorrow are actually a decent value. A lot better value than the Friday expiration. So I'm going to open those, assuming that we're going to be 397 or below tomorrow at the end of the day, obviously. So, damn it, these prices are going up now. This one, I'm willing to risk about 500, I would say. God dang it, these contracts are moving too damn quick for me. I'm just too slow. My hands are too slow, man. All right. Screw y'all. Give me my contracts. Come on, Robinhood. Thank God. Wow, Robinhood actually filled me for a good price on those. I'm shocker. All right. So let me type that in the trade alert very quick and see if we can open a new trade. But, yeah, I'm assuming we're going to go below 397 tomorrow. I think people are going to be watching that 396.40 mark. Watch it go all the way down to, like, 391, where I assume, like, worst case scenario, and I would have made a crap ton of profit. That's going to be my worst nightmare. But at least we have this trade going for us, so let me post that. New options, alerts, premium, 101. All right, freemium. Just opened a new put debit spread expiring tomorrow. 12/15 is the date. Got them for a decent value. Let's see. 44. Okay. Powell kept the markets up during his speech, but I think the summary of economic projections and higher interest rates is going to worry the markets more and cause further sell-off at the end of this week. Okay, so got that trade open. And I really got to pee, so I'll be back in about 5 minutes or so, like 2 minutes. We'll see how quick I can pee. Let me cut my camera off and my microphone. All right, I'm back, everybody. Why is my... Has my video been off the whole time? I'm back, everybody. Why is my... Huh. Why is it not capturing my face? Okay, I guess y'all don't need to see my face. I am a masked man now. Let's see. Yeah, so SPY selling off after Fed Chair Powell's speech ended. Pretty typical reversal after his speech, given that the summary of economic projections was pretty rough. So if you weren't here for the beginning of this live stream, you can either go back, but I'll give a quick synopsis. So the interest rates went a lot higher than what the markets expected for the top end of 2023. They went from the last quarter, they estimated it at 4.4 to 4.9%, but now they're estimating it at 5.1 to 5.5%. So pretty sizable jump in interest rate expectations from the Fed. And now what we know is the Fed isn't going to end up pivoting in 2023. Sorry, I almost forgot what year it was. But now the Fed isn't going to pivot in 2023, which is what the markets really wanted. But markets can't really invest on hope. So if you go to the summary of economic projections, which I think I linked earlier. Nope, that's the wrong FOMC meeting calendar. That's the wrong one too. God damn it. Go to December. This is not the one we want. We want the projections material, please. Well, what the heck, man? Where's... Oh. Yeah, so expecting rates between 5.1 and 5.4% for the end of 2023. And then for the long term, 2.3 to 3.3%. The last time we had interest rates above 2.3% for more than 3 to 5 years, which is what they want. We had the great financial crisis of 2008 and then the dot-com bubble. So, not great. Kind of bearish. Well, I would say very bearish. But right now, SPY's trading at 398.80. So we sold off after Fed Chair Powell ended. So basically all around today. I opened to put debit spread, assuming that we're going to go under 397 tomorrow, and I think that one's a pretty good trade. I think we're probably going to get more sells based on the higher interest rate expectations. Let's see. Let's see what the major news is. So there's a market on closing balance, 95 million to the sell side. Fed still needs substantially more evidence following 50 basis point rate hike. Experts react with famous last words. Oh, God. In determining the pace of future rate hikes, the committee will take into cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. Okay, I mean, this is not really news. I hate it when journalists just post what was in the report and don't really give much insight in it. In a press conference following the rate decision, Fed Chair Powell reaffirmed the central bank's commitment to bring inflation down back to its 2% goal. Recent data is encouraging. He indicated that it's not enough, which very true. Let's see. Reactions from Wall Street. Early reactions to the print are pointing to a more hawkish sounding Fed. I think that they're starting to kind of let off on the hawkishness, given that they went from 75 basis points to 50 basis points. But given that the rate hike, or given the highest rate at 5%, that is pretty freaking crazy. Like, let's see when the last time we had 5% interest rates from the Fed was. Let's see the Fred funds rate. The last time that we had above 5.1 was July of 2006. They kept it up there till 2007. Then it was the Lehman Brothers that ended up crashing down. And then they ended up dropping the rates back to zero because you got to save the corporations. Right? But in 2008, we didn't have the inflation problem. Now we have an inflation problem, more similar to what happened in the 1970s. What's interesting, too, is that this inflation is largely driven by energy prices. So energy prices kind of rule overall prices because energy is the main input for everything. So we had the oil embargo of 1971 or 1972 that ended up sending inflation up to like 9%. We had a recession, so the Fed ended up cutting the interest rates. And every time that we would have like bad economic data, the Fed would cut rates. So if we have the same thing happen again, inflation is just going to stick around and it's going to get entrenched just like it did back in the 1970s. History often repeats itself. But yeah. And then you had, what's his name? Paul Volcker back in 1979 that raised the rates to above the inflation rate. He dropped it back down when he saw economic weakness, and then he finally raised the rates and kept them there for a couple years, and then inflation ended up actually coming back down to more normal levels. Hopefully we don't get that again, because 10 years of inflation at 7%, inflation compounds itself. So if you have 1.07 if we have 10 years of 7% inflation, that means that prices would nearly double over the next decade, which is very hard for, people to get by that are already living paycheck to paycheck, which I don't know I don't know if that's better or worse now. I would think that living paycheck to paycheck has become more common now than it was in the 1970s, but I didn't live through that time. I might look like it with a mustache, but not the case for me. Anyway, SPY's going up a little bit, 399.11. Let's see if we can make any more trades. I opened a Adobe trade, assuming that their earnings report is going to come in rough tomorrow. Assuming that they're going to go all the way down to 330. Going to create an alert with that price level. At or below. Oh, that's not the right price level. Let's see. Lived through the 1980 inflation. It was brutal. Yeah. I can only imagine because, inflation was as high as, 15% back in the 1970s and 80s. We had 12% in 1974. It came back down a little bit, but, inflation just compounds on itself. So I'd imagine that prices probably more than doubled from the 1970s to the 1980s. Anything for Tesla? So Tesla probably headed down some more. Yeah, it's trading at 156. So I have been dollar cost averaging into Tesla, just buying $100 a week, which is, not much compared to my $40,000 cash balance. But, I've been dollar cost averaging just a little bit each week. And I might actually do... I'm expecting the markets to come down a little bit more tomorrow, but I know Tesla sold off yesterday when the rest of the market went up, so I think I might change to buy a little bit of Tesla today. So let's go over to the Robinhood. I already own, let's see how many shares. Back down to 400, so basically back to where I was. Let's see what's killing me right now. Yeah, the SPY put debit spread definitely not going to work out by the end of the day, assuming SPY is going to go below 390. Kind of wish I had closed them for a little bit cheaper, but never got a fill for that order, which blows. Let's see, though. So Tesla, I have 1.08 shares here. I have more shares over on my Fidelity account. How do you compare to do a sell call put at, say, 4:50 p.m. versus the next morning at 9:30? I thought the former is better. So there's no time decay over the night. There is time decay no matter what time it is. So even on weekends, you're going to have theta eating away at the contract's value. Time decay happens no matter what time it is. God dang it. Why do I have to type in a security code? I just want to see my shares of Tesla. But yeah, theta doesn't really care about after hours. It doesn't care about weekends and stuff. Let's see. I only have 5,500 in this. Where are my shares of Tesla? Positions. I have 35 if I remember right. Yeah, 35 shares. I don't know why it says that I have these on margin. I know I don't have them on margin. I paid cash for them. QQQX is at 18. I might buy a little bit of that, but that one's not down today. But I want to pick up some more Tesla. I've got 35 shares on here. I've been dollar cost averaging 100 a week into the Robinhood. Meditating on buying some Tesla. I mean, let's see. I think I'm scheduled to buy some on Friday, but I'd rather pick it up now just because of how far it's fallen. So I'm going to pause this and just buy 100 at the moment. So $100. So give me 0.63 shares. All right. So just following through with my dollar cost average plan. Gonna post that to the trade alerts. So this one's a buy alert instead of a options alert. Just bought 100 of Tesla at 156.37 price. So let's see. Had it at 274, down as fuck on Elon. Yeah, I mean, that's what you get when you invest with Tesla. You get all that comes with Elon, the good and the bad. I don't really mind it. I think that he's a brilliant man. Personally, I think he's tried to do good for humanity, and I believe in his missions that he's got. So I do think that he's chaotic neutral, but let's see. So the put debit spread I opened is down right now. Still gonna hold it. I still think we're falling tomorrow, just based on the summary of economic projections not coming out great. Tell that to my holdings, yeah. Yeah, I bought my shares back in summer of 2020. So my average cost is like $130 or $140, so I'm still slightly positive, obviously. Not as positive as I was when Tesla was trading at 250, 300, but I did end up selling about 70% of my shares. Yeah, if you dollar cost average during this year, like, you're definitely not doing great. But, I mean, given that the Fed has tightened so quickly, and now that they're going to start slowing down on the interest rate hikes, and in 2024, you're probably going to start getting QE, or at least they're going to stop raising the rates. I think 2024 is what we need to look out to. 2025. And then probably, I think the cycle of monetary policy usually lasts about 4 years. And then, like, we have a great collapse, like the great financial crisis. In 2018, it was cut short thanks to COVID in 2020. I guess before then we had 1994 to 2000, so that was 6 years. So based on the averages, it's about a 4-year cycle. So you might not see very good returns for probably the next 4 years. So that's why I'm dollar cost averaging very slowly. Like, I am only dollar cost averaging like 1% of my cash each week, and that's my current cash pile. So I have 40,000. I'm dollar cost averaging $400 a week. So that means that based on my current cash balance, I can dollar cost average for the next 100 weeks, which is roughly 2 years. Yeah, Tesla shorts definitely printed last week. Started at 179. There's a lot of volume yesterday. Huge selling. There's like a block for like $3 million or something. A sell block for that large, which is a lot. Not sure exactly where it came from. People are still speculating on that, if it was Elon or not, but not really too sure of Elon's antics. You put me on the QQQ. Yeah. I think QQQX is a very good place. Just because you get that added income, right? Elon who? Elon Musk. Not sure if you're joking there. He's just the richest. Well, he's not the richest man in the world anymore. He lost that title. I wonder if he'll regain the title after SpaceX gets its valuation. I would think so. But I think SpaceX, they're trying to value it at like $100 billion or something like that. I'm not sure. Let's see. Yeah, UVXI is definitely sinking like a ship. 694 right now. Ugh. God damn it, UVXI. Why you gotta do this to me? Damn it. Let's check out the regular VIX, see what that's up to. So that's back down to 21. It went all the way up to 26 and then reversed already. Let's see the yearly chart, see what that looks like. I still think that the cycle is going to keep going. So the VIX is very cyclical to where, like, you'll see something probably like this first one where we rose a ton, dropped, went back up. I would think if we get more and more recession fears that VIX is probably going to go up. This is something that somebody in the premium Discord was telling me. Probably going to be more recession fears, which would cause VIX to go up, especially if there's any really bad news, like funds that end up, going belly up, or stuff like FTX or BlockFi, but on a larger scale, right? If something like that happens to like a large financial institution, like an actual traditional bank, that would be pretty rough on the market. Obviously, like, low likelihood of that happening. But I do think recession fears are going to continue spreading. Probably going to see some rise in the VIX. I don't know if I'll sell my shares just yet. All right. I bought these shares at how much a piece? $7.65. So I'm down $200. But again, this is very cyclical. It'll go back up eventually. The problem with UVXI, though, is that it's 1.5 leverage. So since it has that leverage, it's going to lose time value, which won't be great, but we'll see. How does QQQX differ from QQQ? So QQQX is a fund that sells covered calls for QQQ. So basically, they'll sell those covered calls for you, and they'll pay you back. So if you look at QQQX on Robinhood, you can't buy it on Robinhood. You have to buy it on different brokerages. For some reason, it's not available on Robinhood. I bought my shares on Fidelity, but the yield, so what they pay you back is 8.4%. So if you look at the last 5 years of trading, it's down 4.92%. But since you're getting around 8% a year, with the cash that they're paying you, that would be 1.08 to the fifth power. You'd be up about 46%, or you'd have 46% more cash if you didn't decide to reinvest it. What's the difference of QQQM? I'm not sure what QQQM is. I've never heard of that one. Exchange Traded Fund Trust Invesco 100 ETF. Passively managed to track modified market cap. So I guess that's just based on like a different. It's got 105 holdings, not 100, but I guess they just weight it differently than the regular QQQ. I'm not sure how exactly they differentiate, but yeah. But basically, my plan is to keep investing into QQQX until I can afford 100 shares of QQQ myself. So I'll sell however many shares it takes to get enough money to buy QQQ and 100 shares of it, and then I'll start selling the cover calls myself. That's the plan for right now. Binance is going to go under very soon. Well, Binance got in trouble for money laundering, so I don't know if they're going to go under per se. I think that they're going to get a lot of litigation against them, but litigation doesn't necessarily mean that they have to stop business. Yeah, so Robinhood has QQQX, but you can't buy it. It says not supported on Robinhood. But let's see. Got about 1 minute left. Let's see how SPY ends the day. Currently below that 400 mark. So we just ended up between the 396 and 400. Ended up trading flat. I guess once the Powell speech started, we just traded flat. Interesting enough. Got about 30 seconds left. All right, let's see if we end the day above 400 or not. Doesn't look like we will, but maybe somebody comes in and buys at the last second. No, looks like we're going to miss that 400 mark. Yep, end of the day at 399.40. So that's the end of the trading day, and I will catch y'all again tomorrow in the morning at 9:30 on Open. All right. See you, everybody.